All right, hey guys, it is 2:47. This is the second video as promised today. This one is on Kansas City wheat. So all we're going to talk about here are re-ownership possibilities for Kansas City wheat as it applies to people who are already in short positions, whether that's a short position in a futures account or whether that's a short position in a cash sale account or via a cash sale. We are not talking about speculating here. So if you're a speculator and you're listening to this video, this is education only. I'm only talking about hedging and re-ownership here, and I don't think I can hammer that any harder than I just did. So take this everything I say next accordingly. All right. Now with wheat, here's what we're looking at. All right. We've got this move higher and we've got this bullish cloud and we're above our hedge line, and really all things seem to be pointing to go. We know that our weather is deteriorating in the Kansas City wheat crop, not getting better. And we also know that there are some underlying fundamentals that might be more bullish wheat longer term than bearish. And for a long time, we have been on the camp of the corn fundamentals are so bearish, wheat's got to go lower, because because wheat is currently being held high by the tight feedstocks in western Kansas. And as soon as those conditions are lifted by new corn bushels, then wheat should come down as well. Now, that logic goes out the window if there's actual wheat demand that is indifferent to corn supply, because if that is there, then we need to go higher. So that would be the fundamental reasons why wheat would go higher. New demand and decreasing supply. That would be fundamental. And technically, though, front and center here is this setup. So if you have been short wheat via a cash sale, okay, and you've made these sales at any point in the last year, you've probably looked for reasons to re-own it. And we've been really hesitant to put on any re-ownership positions because of that bearishness, and because nowhere back in here did we have a really good bullish setup that we thought made sense. But at this point, I think it's prudent to say, hey, we think that we could grow some legs and could work higher. And so if you want to re-own your crop and you want to, or a portion of it, and you want to participate in the upside by not capping your sales, then I'm going to give you a couple of different strategies for how to do that. Now all of these strategies assume that you have a cash sale on somewhere, whether that's an HTA, a full-out cash sale, or some sort of a min-max, okay? And if you have those positions on, what do you do if you call your elevator and you ask them to reposition you or reopen your upside? What do you ask? Well, the first thing that you could do is you can just exit the futures position. You can say, hey, I've got an HTA or a cash sale and I want to open my future side back up, and they may let you just exit it. And if that happens, your upside's completely open. You are just long your cash crop, and you can resell it at a higher level. And if you do that, then where are we wrong, and where are we in? Where do we want to put that hedge back on? Well, I'll give you a range. We want to put that hedge back on if we trade back below 823 or down to 802. 823 to 802 is the range in which you want to put that hedge back on. I would err on the side of higher, because if we do get back down to that level, then we have traded back down below our hedge line and back into this level here, okay? So 823, 820, somewhere in there is where you would want to put that hedge on. So you call your elevator and you say, can I lift the futures on my HTA? And they'll either say yes or no. And if they say yes, then you can say, okay, but I want to put a stop on, and I want to put them back on if we fall below 820, 823. And then your elevator will say yes or no. And that's totally dependent on the merchandiser and the policies that you have in effect at whatever sale destination you had. Now, a second policy, if they say no to that, and you would rather do this, then you can, instead of that position, then you can transition to a, a long call, which means that you would still have your short futures, which means your hedge is still in place, but now you're going to put a call on it. And by putting a call, here is what you're doing from a cash sale standpoint. Let's say that you are currently sold at $8.50. For round number purposes, let's say you're sold at $8.50. If you add a call to your $8.50 price, here is how you should think about it. You should think of it in terms of my new minimum floor is $8.50 minus whatever I pay for the call. So if you pay for a $8.60 call, they're trading about 40 cents. So now my $8.50 sale becomes $8.10. That's how you think about it, because it's your sale price minus the call price. And in reverse, where does my hedge become in the money if it works higher? So if you pay 40 cents for an $8.60, that really starts to pay off at $9. So you've got a complete re-ownership position on at $9 with a floor of $8.10. So it gives you a range. And if you look at this chart, it makes perfect sense what the options makers are doing. They're giving you an at-the-money call that pays out above that high. They are willing to sell that to you, guessing that they will make money as long as corn or wheat stays below this $9 level. Okay, it's a very efficient market. That's how the options are being priced. And on the flip side, the 820 level or 810. Remember, I said we're wrong at 823 down to 810. Well, 850 minus 40 is 810. That's really at the bottom side of that range. So the options writers are giving you at the money calls for the top of the range to the bottom of the range, and that's how it adjusts your position. Most elevators will let you do that. Some will not. Certainly, it's worth the conversation. Now, a third strategy that you can have would be to, well, hold on. One more thing about calls. You can choose to go at 40 cents here at the money, or you can choose to buy a call at $9. That will be less expensive. They're trading for about 20 cents. And so in that instance, your $8.50 purchase price would be $8.30 as a sale price would be $8.30, and your new true in the money's position would be $9 plus the 20 cents that you paid, so $9.20. So it gives you a little bit broader window. It also gives you a little bit less exposure on the premium. Now you can cheapen that up by either selling a call up above it, which you won't get a lot of money for, but it might give you 2 or 3 cents, or you could sell a put way down below it if your elevator is willing to let you do that. And again, that limits that puts a cap on your floor, and it limits how much of it you could get. I don't think we're going to go to $10 or $10.50, but I do think we could go press 9 and push up into this $9.50 area if things were to get a little bit exuberant. So I kind of like the idea of picking up some premium off of the $8.60 put calls or $9 calls. Either one works for me, and that's kind of just up to you and your preference. Now, a third strategy, and one that we used at the end of 2020 or in August of 2020, when the technicals and the fundamentals were disconnected in a similar fashion to this, where the fundamentals implied much bigger carryouts, because in August of 2020, I mean, I think we were printing a 3 billion bushel number, or 2.9, because we had a massive crop, we had COVID, we had no demand, oil went negative, and it was Armageddon for the grain complex. But we didn't break $3, so we turned. And so the strategy we used in that instance was we exited our futures and we replaced them with long puts. And so what that did is that gives you a floor and leaves that floor intact, but it opens your upside completely. So in this instance, what we would do is we would say, hey, where are we wrong on our futures position? Well, we're wrong at 824. So we would buy an $8.20 or $8 put and exit the HTA or exit the future side of that position and leave the upside open. Some elevators will do that for you, some will not. You just have to talk to your merchandiser and ask them what's appropriate. But all of those strategies are limited risk, which means that you will all of the option strategies are limited risk, which means that you will maintain some semblance of your hedge, and you will have your upside reopened. And it depends on your risk tolerance and your financials as to how much risk you're willing to take in the middle of this range here. Because like we said, the options makers are really giving you down to $8 and up to $9. They're really comfortable that wheat isn't going to move beyond that. And if it does move higher, then you want your upside open. If it doesn't, then we certainly want to know where we need to put our hedges back on. We think that that's an 824 level to be exact. Okay, I think that's everything that I had to cover for you. We will send this video out with at the same time as some of the rest. If you have questions on those strategies, please call. We're happy to talk you through what that means for you and where to do it. And again, everything I just talked about is not speculative. That's only for hedging, and it's assuming that you have some sort of a forward cash contract on with some end user that you need to modify or adjust. If you're in a futures account, you can take the same strategies. It's just a little bit different management. So reach out to us and talk to us if you're going to use those to manage your risk. All right, remember, there is risk in trading futures and options. Even when you're hedging, it doesn't guarantee a good result, and you can always end up losing the money that you put out for your hedge. So I want to be crystal clear about that. But there's still good tools out there, and as long as you are aware of the risks. Hope you guys have a great day. We'll do corn next, and we'll talk to you in a minute.